Welcome back. Let's invite Sandip Agarwal, fund manager at Sowilo Investment Managers, on the show now to talk about Wipro, to talk about the IT sector ahead of earnings. So Sandip, let's begin with Wipro. Now, Wipro seems to be using M&A to buy growth. So they've struck this $1 billion deal with Olam. But it comes with Wipro having to buy Olam's captive IT unit called Mindsprint for $375 million. And if you just look at the way the deal is structured, so Mindsprint's revenues were $135 million as of last year. The contract runs for 8 years, which means $135 million into 8 years is $1 billion, which is what the deal is about, a $1 billion deal. So there's no revenue outside of what they're paying per se for the acquisition. What have you made of this particular transaction, and what do you think? There is revenues, but what would it mean for Wipro's margins?
Hi, good morning, Rima. So I generally avoid commenting on company, but since we don't have this in our portfolio nor we recommend. But let me put it this way as a tech expert that, if you take 15-17% IT services margin where, Wipro has been operating, then it means 175 million in the next 10 years, right? So basically they are paying $200 million, and this is not a NAV, right? Because you have to discount it. So then, it boils down to the fact that you are paying around almost 250 million or something like that for getting either entry into the markets, entry into the clients, or entry into the FMCG and agro clients globally. So that is what you are paying for. Now, I don't know Wipro itself has such a strong capability in consumer side, whether they really need to go for the capabilities. So it looks more like, multiple factors, including that, to get a large deal and also to get some of the clients which they may not have, or maybe some of the geographies, the Middle Eastern market or some other geography, because if you see Olam operates mostly in Singapore and Middle East. So maybe because of that reason. Otherwise, on pure commercial, yeah. No, so I would not comment bad or good, but I would say that I don't know real rationale behind it, because on one side you are taking, you are paying 375 million. Even if you make 15-17% margin, it is very tough to find out what all benefits you will get. But let me put it this way, that if you see the global talent chart and the cost of execution chart, you will see that after India, the highest amount of tech resources in the world at lowest price are available in Singapore. So that is the second country with which we closely compete, and their prices and their cost is almost 7-8 times of us. So, in that sense, maybe, the second best option of acquisition was in that geography, and maybe they would have gone ahead and done with that purpose. Generally, most of the IT companies, when they acquire in Europe and others, there is a loss at the EBIT level. We don't know whether there will be loss or profit, but that is what my understanding is. I would not put it as a great deal or a bad deal because of insufficient evidence or data. But yes, this is what it is. It is a cost takeout kind of deal.
But is it signaling that organic revenues and growth is difficult to come by, which is why we need to get these $1 billion deals, but it's attached to conditions by the M&A arm? Use M&A to buy the captive IT arm.
So, Rima, if you see the financials of Wipro, for example, last few years, they have not been able to grow much. That is a fact. They have, in fact, not grown well in last 12-15 years, except barring 1 or 2 year or quarters. So from that perspective, they don't have a choice. But so right now, the isocon which they are doing is that the money which they keep as cash, what they make on that, and versus that, if there is a higher ROI on an acquisition along the companies are doing. So if you would have seen that a large tech company, one of the largest one, announced data center, and that business, again, the rationale there will also be that, the margins and the ROI in that will be much more superior to the benefits which they are getting by keeping that money in bank. So that is the way now things are happening. That is a mature business cycle, and that remains like that.
Okay, now let's get to the IT view. Sandip, because you were very bearish on IT through 2024, 2025, and now you've turned extremely bullish on the IT sector. Take us through. What's changed?
So, Rima, the simple change which has happened is that, 1.5 years back, the stocks were at 5-6 times PEG ratio. You take the large cap, you take the mid cap or small cap. That was insane in my view. Now, what has happened? One, the index has corrected 40%, which was in line with my expectation 14-15 months back. And the stocks, some of them have corrected even more than that. So that slashes down your PEG ratio, let's say from 6 times to 3 times. Now add on that, 1.5 year, they have made some money, right? So that if you do that mathematics, they are at 2.25 times PEG ratio. And now with rupee depreciating almost 13% in last 1.5 month, we are talking about 1.2, 1.3 times PEG ratio. So just for your information, the earnings of most of the tech company will at least grow by 15% to 25% depending on the margins of the company only because of rupee depreciation, which I don't think people are taking into account now. So if you are going to get, let's say, a CAGR of next 2 years earnings of even 15, 17%, then the multiple are 13, 15 times. There is no case for being bearish on this. And see, I don't believe that AI will take away the IT services piece and all that. I think there is a 20% reduction in effort spread over 5 years. So you have a 4% deflation annually and you make 5, 6, 7% new business, you are home. And I think we are in that situation. So paying a 1.5, 1.2 times PEG ratio versus 6 times is a very good correction in my view. While stock may look at 50% correction, actually the multiples have corrected, the PEG ratio is corrected by 75, 80%. So it makes a strong case for all the tech companies. I will not name out anyone. Only caution which I will say is that I will not buy still the ER&D companies. I will buy ER&D companies after 6 to 8 quarters of, once that Ukraine and Russia war gets over. After that, 5, 6 quarters later, I will start buying ER&D company, not now. But other than ER&D, whole IT service space, I love the space. Now with the correction, I think that there is a good money to be made. Again, this is not a sector which is structural in nature.
Yeah. Sandeep, hi, morning. Prashant here. So just to wrap up, so you're saying the last point is important. Sometimes valuations get attractive and then they can remain attractive for a long time. So you kind of sort of buy in and then you wait and hold on and it's dead money for a long time. This is not that case. You're saying there are triggers and these earnings will come through which markets are not anticipating, and hence over the next 1 year, you will make good money. That's what you're saying. So if you have 100 rupees to put in, where would you put it in? I mean, and the thing is, you're not just focused on, you track IT, but you look at everything. So and in markets, opportunity is all relative, right? So IT would be top of the list. So how would you allocate it, Sandeep?
So Prashant, very good question. So let me put it this way. This is a trading sector with a 5, 6% growth for large cap and 8, 9% for mid cap for next 5, 7, 10 years. And you add rupee depreciation benefit, whatever it is. So I think that now is the time when, because of rupee depreciation, suddenly 13, 14% return additional, and last 2 years there has been no return. So I think broadly 30, 35% kind of return in the sector can be made from here. If it happens in 2 years, it will be 15% annual return. If it happens in 1 year, it is 30% in 1 year. If it happens 6 months, great. So I don't know in what duration it will happen. Generally, I have seen that, mispricing get corrected very, very quickly. So I was almost zero weight in IT in our PMS for last 15, 16 months. I think now the time has come where I will go at least equal weight, whatever is the weight of the index in the of IT in the index, or maybe 1, 2% overweight. That is the way I am looking at it.
Okay. All right. Thank you very much. Good speaking with you, Sandeep, and always useful to talk about the IT space, and of course also about how to approach things. And once this Iran thing fades away, we can maybe we were having all those conversations around AI, and Sandeep is a keen watcher of everything AI and impact on IT software companies and elsewhere. So we'll sort of get him back on more regularly. Thank you. Well, Dharmesh Kant is with us.